JB Knowledge Podcast Network. On episode 53 of the InsureTech Geek Podcast, talking about digitized home insurance through independent agents with Ty Harris from Openly. The InsureTech Geek Podcast, powered by JB Knowledge, is all about technology that's transforming and disrupting the insurance world. We'll be interviewing guests and doing deep dives into specific tech we see changing the industry. We're taking you on a journey through insurance tech, so enjoy the ride and geek out. All right. Yeah, another Friday, another week gone by, halfway through March. First quarter's almost over. What the heck? 2020 blew by. 2021's even faster, and this is nutty. Crazy deal. Rob Galbraith, how you doing, bud?
I'm doing great, and it's great to have you back this week, James. It was a tough assignment going solo last week, but managed to pull it off.
Well, yeah, thank you for handling them. Sorry, I had some things come up, and I appreciate you as always being an amazing co-host on this show. But it is good to be back here in the great state of Texas at our headquarters, at JB Knowledge headquarters. You can see them at the office, not the home office, not the coffee office, or they call it the coffee shoffice. This is the office office. We getting some things fun back up. Of course, I'm excited to be driving to work every day and have a little commute to listen to my podcast again. I was missing out on my commute podcast and audiobook time, so I'm excited to have that back. With us today from one of the prettiest cities in the South, Charleston, South Carolina, is Mr. Ty Harris from Openly. Ty, thanks for joining us today.
Thanks for having me. Really excited to be with you today.
Yeah, we're going to have a good chat about modern tech for insurance and why agents are still relevant. We'll see. We're going to find out. We're going to talk about that with Ty. Before we get started, though, don't forget you can subscribe to the InsureTech Geek Podcast by texting Geek Out. That's Geek, Geek Out, to 66866. Make sure you never miss an episode. We email you every week with the show notes, the links to the articles, and just what's going on with the show. And you can listen to who our guests are. We got a great one today, and we are excited again to have Ty Harris from Openly. That's openly.com, OPENLY.com. He's the co-founder and CEO there. Now, this is interesting because I do two podcasts. I record both on Fridays. My previous guest this morning was a Duke grad as well. So you gotta love that. And he went there at almost the exact same time as you. No, he was there a few years before you, but his name is Brian Helm. He went to Duke University, and then you went and did some post-grad work over at MIT, where they're wicked smart up in Boston. But let's talk about your kind of early days and what led you to Openly. I don't want to talk about Openly yet. I want to talk about the foundation. Like give me the origin story of the superhero here. You were born and raised in Atlanta, I believe. So just tell me what was that like growing up in Atlanta? And what did you envision yourself doing, and what led you to doing econ at Duke and MIT?
Well, I just woke up in a field one day, and no, I'm kidding. As you said, I was born in Atlanta. My dad was an airline pilot, and Atlanta's a huge hub for Delta Airlines, so that's kind of how we ended up there. I was a pretty kind of nerdy person, I'd say in general. I was pretty quantitatively oriented, academic and all those ways. Ended up going to Duke. And if you had asked me at that point, would I end up in insurance? That was probably number 185 on the things that I could conceivably ever picture myself doing. I went from Duke to a place called the Brookings Institution. Well, first of all, at the time, at least, that is probably unfair, but like a lot of the career paths from Duke were very professionally oriented. So you're going to go become, an attorney or a doctor. There was not a lot of focus on entrepreneurship in particular. There was some on finance, but certainly not a lot of focus at the time on entrepreneurship or insurance. So I went from Duke to a think tank in DC called the Brookings Institution and did various quantitative research there, which ultimately led me to MIT grad school in economics. And that was a great experience. I was in a class of 25 people from all over the world studying economics. I specialized in market microstructure finance, so very, very quantitative kind of theoretical areas of finance. And at some point, I loved the the coursework, and I loved many things about what I was doing. I was teaching while I was there, which was very enjoyable. But there came a point where I came to the realization that I didn't actually want the full academic career, that I wanted to go into something more businessy or more practically oriented. And at the time, I was a huge poker player, and I was into finance and statistics. And so I was like, well, I could go to Las Vegas and work in a casino, or I could go to an insurance company, which is the other area where I saw lots of,
Not a lot
people.
of difference,
Not
right?
a lot of different. Exactly. That's why I lumped them together. And Vegas was a ways away. I guess Foxwoods wasn't that far away, but Liberty Mutual was just across the river from where I was living in fabulous Cambridge at that point. So I went to Liberty Mutual from grad school. I kind of started over in a way, relative to an academic career. I was a beginning actuary, so I went in and I was an analyst there. Took all the actuarial tests over time. Kind of cut my teeth. Had some great mentors. Cut my teeth building home and auto insurance products for Liberty. Was there for about 12 and a half years. Had a great career. In the end of that career, I was actually the chief product and underwriting officer globally for their personal lines of business. And I mean, again, I can't say enough about that nice corporate job with great people and doing great things. But I think a combination of a couple of things ultimately drove me to Openly, and one was really inward looking and personal. And I realized that the times in my life that I had the most enjoyment and fulfillment were times when I was really building something from nothing. I mean, whether it was building something at Liberty, or building up myself as a runner or a ballroom dancer or a poker, whatever it was building rather than defending. And that's what I wanted to spend my life doing. And the balance wasn't quite right in a big corporate job. And so that was the inward part. The outward part was I being at a big company doing insurance for a while, you see lots of opportunities where, just with some hunger and some, what I would think of as like first principles thinking, there's just a lot of opportunity. And Openly is going after one or two of those biggest opportunities that we saw.
Yeah, absolutely. And we'll deep dive in Openly in a minute. I just want
Yeah.
to kind of jump into foundation. Now Liberty. First off, if you don't know who the Brookings Institute is, do some reading. Pretty cool place that you were at, and a good healthy study of economics. I think is good for everybody in the business world to understand how economies work and how supply and demand works. There seems to be a fundamental lack of understanding about anything about how supply and demand works. People complain about supply demand curves all the time, and just demonstrates a fundamental lack of. To me, economics is fascinating because it's a study of human behavior, right?
Mhm.
You're really studying human behavior. People are heavily incentivized, and they behave how they're incentivized to behave, and that's a fundamental tenet you have to understand to study economics and to study like existence. And that they respond to changes in price, price flexibility and price elasticity, right? All these wonderful things that you study in economics. So I think it's a wonderful foundational principle. You obviously learned a lot at Liberty. I mean, there's pretty sweet place, right? I mean, there's a lot of cool people there, a lot of progressive thinking at Liberty. I mean, you got to be a big part of that for quite some time. What are your top three takeaways from your time at Liberty?
Well, one of them was the first day as a beginning actuary. I walked in the door and they handed me the spreadsheet with the rate indication. And I, as the theoretical, academic economist, assumed I was going to go in there. And I always wondered, like, how much do insurance companies actually take? Like, could consumers put up with, what, like they get back 99% of the money and 1% goes to like manage the company, or is it 90-10 or what? And lo and behold, I mean, this is nothing against Liberty. They actually have a decent expense ratio, but as people in the industry would know, only about 60% or less of the money ends up going back to consumers. And so with, full on 40+% going to administrative expense, there's obviously some profit then on top of that. But so one of the huge things that struck me just my whole time in the industry was like, if this was a 401k, would you put up with 40% of the money you put into your 401k, like going to the expense load and the 60% going into your account? And you in some ways you should think of insurance that way. I mean, it's not a perfect analogy, but it is an investment product with, negatively correlated with your other things in your life. But you shouldn't put up with 40% of the money kind of going down a hole. And I think that's existentially the industry. I know why it is, and I've seen it and I understand, but like that has to change over time. It's not tomorrow, but that will invariably be dragged down over time. The industry has to, if you want to call it commoditized, that will, if you want to put that label on it, that will happen. So that was one of my takeaways. Two, was that, and relatedly, is that I think transparent choice is coming to the U.S. market, and some people would say, "Oh, it's already here." But it's not here the way that it is in like UK or Spain motor insurance, for example. And I think carriers need to be even more rapidly preparing for a world where they are spreadsheeted and price compared far more than they are today. The other thing I guess I would got a great takeaway, I would say, coming from Liberty in particular, was just the emphasis on talent and how to do that, how to build. I had an organization of 800 people when I left, and coming from an academic economic background, you would never have guessed. You would have thought of you think of companies in some ways as point particles in economics. That's not really fair, but like you don't understand how much great people can make a difference relative to the same business plan with not great people when you're studying academically. And the management skills and the talent, the importance of talent was probably the most critical thing that I learned while at Liberty, I'd say.
Yeah, absolutely. Absolutely. I mean, that's certainly usually the harbinger of success or failure at an
Yeah.
organization. So that's a really important one. And it is an interesting analogy when you compare insurance to your investment products, because you're like, yeah, no, wouldn't accept that at all. Why do I accept this much overhead over here, but not over here? What makes it different? And largely because it's a black box to most people, right? I mean, it's just this hole you sit and put money into, and you hope to have protection in case something bad happens, and that you have some pricey assets that you want to take care of, and so it can be really challenging. Rob?
Yeah, it's funny, Ty. We actually have a lot of, I guess, intersectionality, interestingly enough, in our career, which I'll get to in a moment. But building on your point, I actually just gave a talk to the casualty actuaries of New England, ironically enough, this morning. And just, I make this point in my book, and I've made it pretty much in every talk that I've given about the end of insurance as we know it, is when you look at the industry expense ratio, and this is all lines lumped together, so personal lines, commercial lines, right, short-tailed, long-tailed, et cetera. But on average, it's about 30%, and that number has not budged in the last 10 years. So if you think about, premiums have gone up quite a bit over the last decade, and you think about all the investments that companies make in technology and experiences of the whole 9 yards, right? And we are not getting any more efficient as an industry. Exactly to your point. And I always tell people to compare it to credit cards. You've got large card networks, Visa, MasterCard, American Express. You've got large banks issuing it. You've got lots of regulation. You've got lots of fraud, and yet they're able to do that at 3%, right, for the exchange fees. And so we're about 10x that. And I'm not saying that we'll ever get down to 3% expense ratios in the insurance industry, but I think 10x over credit cards is a little too steep, right? Especially at a small scale. Credit cards is a substitute, right? You break your iPhone, like either I have insurance on it or I buy a new one out of pocket, and then I have some flexibility of paying off my credit card and whatnot. So I love the way that you're thinking about that. And I mentioned the intersectionality. So I too am an economics major at a basketball powerhouse, slightly different, Michigan State than Duke, and obviously big rivals. And I'm very proud that my Spartans got their first win ever at Cameron Indoor. Granted, no fans, no Cameron crazies this year, but no asterisk from my standpoint on that victory. And I actually was a research assistant at the Federal Reserve Board right nearby in the late 90s. So who knows, we might have visited the same bar or two at some point along the time. And I actually had a very good friend of mine that was also an economics major and went on to a grad program at MIT during the same time. So we'll have to check with you off air and see if we happen to have that common person. But I spent 20 years at USA in personal lines, so definitely a lot of commonalities there.
Yeah, well, it's funny. As I recall, one of my more glorious duties when I was at Liberty Brookings was to go fetch some report that came out from the Fed like every Friday morning. So at the time, you'd have to like physically run over there and get this paper and run it back to my boss, and it was a time-sensitive thing. It's probably a little more electronic now, but I might have been near.
Yeah. I was a little behind the time. The technology was slightly too advanced, unfortunately. But they used to have a plotter at the Federal Reserve that was a computer program that would spit out to literally a pen, like in a piece of paper, and it would program the pen to draw the chart. And they said that they would go out and throw a frisbee on the Washington Mall for an hour while the plotter was drawing the line on the pen. So I definitely want to come to Openly. And one of the things that really struck me in reviewing your website and what I know about Openly is this promise of beautifully simple home insurance. So Can you describe for our audience, what does that mean, and how are you different from a traditional carrier like a Liberty Mutual, USA, and others?
Yeah, so let me just to set the stage. We are effectively a kind of an upmarket homeowners insurance carrier, right? And as we've noted, selling through independent agents exclusively. And but to give you an example of what we mean by beautifully simple, I think one particular kind of microcosm might bring it home. So if you think about how everyone buys and sells home insurance today, one of the biggest things you have to decide as a consumer, as an agent, when you're buying is what coverage A, they call it, limit on your home insurance do you want? I.e., if your house burns down, how much would that cost? And when you buy your policy, that is the number one rating variable. It's almost one for one with the coverage A limit that you select as a homeowner. The carrier might have some model that underlies it and gives you guidance. The agent might have an opinion. Your lender might have an opinion. And it's very common for for actually a customer and the agent and the lender to be in this three-way triangular argument about that value, because the lender says, "Hey, this is a $800,000 house." Because that's the market price, but then you say, well, actually, it's only $500,000 to replace, and then the customer, and it's this huge, and then you inspect it 30 days later, you get a different answer, your price changes. So it creates this big friction at point of sale. Then it creates friction at time of claim potentially, right? So it's uncommon, but if a house does fully burn down or get destroyed, the customer can be out of luck if they didn't have enough coverage. So it's this perennial risk that's sort of on the agent, right? And also very much on the customer if they guessed wrong when they bought that coverage. And then the triad of the problem is that it actually leads to less accurate rating, because think about it, you've got this massive variable in your rating model, your pricing model, that is ultimately subjective. I've looked at a bunch of real quotes and data, and very common for a $400,000 house to get marked up or down by $200,000, even $400,000, because of someone's opinion in the process who really didn't know what they were getting at. So what we do that solves all three of those problems is we use, again, kind of pulling on the thread, first principles thinking, to say, why don't we just get rid of coverage A? Who needs it? So what we did was we got rid of the very concept of having a coverage A limit. So when you buy an openly policy, uniquely, I think, among carriers, you don't select a coverage A limit. Every house we write is guaranteed to $5 million. So you've already solved that customer possible gotcha, which is a big theme with openly. So you've simplified the policy in that sense. There's not this gotcha waiting for you. You've simplified the purchase experience and sped it up, because there's not this back and forth argument and dissatisfier. And you've made it, the pricing, more accurate, because you're pricing it on the underlying attributes of the house that actually create risk: the square footage, the bathrooms, the roof, et cetera, as opposed to this one single number, which really doesn't capture the risk appropriately anyway. And so that, to me, is the quintessential. We've tried to do that same way of thinking 100 different times and make better algorithms underlie a better customer experience and fewer gotchas for the customer. So it's faster, and it's better coverage, and it's actually a more accurate price at the end of the day.
Yeah, the coverage A thing is really fascinating to me, Ty, and listeners know that James always likes to geek out on the technical side, but I'm going to geek out on the insurance side for a minute,
Do
because
it.
that is a major problem. And when I was at USA, particularly the California wildfires, I think really kind of hit it home, where you've got these homes and they haven't been properly kept up to date either. And so the way they were being priced and the way they were being settled, and I would say that USA is actually pretty good in terms of their catastrophic claims relative to other carriers. But yet you had this phenomenon where, hey, your home's burned down, you only have this much coverage. So you had a 4-bedroom home, but we only can afford to build you back to a 2-bedroom home. So, or, do you want the bedrooms gone, or you don't want a kitchen, or, how do you want to rebuild? And it's just this really painful process on the back on the claim side. And I remember advocating for a time, like, for all the reasons you said, hey, why don't we just get rid of that? And everyone said, yeah, that's a good idea. And then nobody did anything about it. So that's really great to hear what you guys are doing it openly. And I think that's a perfect example of something that needs to be improved.
But does it really eliminate the argument over what the house is worth?
It eliminates it from the purchase decision, which is 99.9% of the time that you would ever have that argument. So 100% of customers today, when they purchase the insurance, need to have this discussion. Sometimes it's an argument, sometimes it's not. 0.01% of customers actually have their house burned down. And to be truthful, you're going to have that discussion no matter what, because even a traditional policy covers the replacement cost of the home up to some limit. So the carrier is going to potentially, there's going to be discussion about what the real replacement cost of your home is anyway. And in our case, all we say is we're going to have that discussion just like any other carrier would about the replacement cost of your home, but we are not going to artificially limit it. If it turns out the replacement cost of your home is higher than you might have thought or you might have guessed had you picked a Cov A, you are covered with Openly up to $5 million as a replacement cost.
It's certainly a different way of underwriting this, right? I mean, that's the whole point.
It is. I mean, but think of like, I mean, this is not a perfect analogy for a lot of reasons, but think of like auto insurance. Imagine that when you were insuring your car, you got into like a month-long discussion about the replacement cost of your car. Now, it's not perfect again because cars are more homogenous than homes, but I'll tell you, like auto insurance pricing, the center of auto insurance pricing is not the replacement cost of the car, right? It's a bunch of other things that determine the risk of that
Yeah, the stuff the car is
driver.
going to hit.
Right. And we're doing the same thing with home insurance. We're saying that the centerpiece of this whole edifice can't be the replacement cost for the 0.01% of the time that it's going to get fully destroyed. It should be the all the attributes that contribute to the risk appropriately.
Yeah, yeah. But let's talk about the other thing that common InsureTechs are doing, and that is leveraging a lot of public databases to streamline the application process. Talk to me about how you're leveraging public data to keep your application forms short, simple, easy to use, and how that's factoring into your customer experience.
Yeah. So when an agent, again, we distribute exclusively through independent agents, and I'm happy to talk more about the thesis there and what I mean by that. I
Oh,
mean,
we're going to.
uh, but sure. But just to answer your question, agent has a customer on the phone. They ask the customer for their name, date of birth, and the address to be insured. With those three pieces of information, we're able to return a bindable quote on up to a $3 million home in about 8 seconds. And way we're able to do that is a combination, as you alluded to, of sourcing a lot of information. Some of it is public, some of it we pay for, some of it we have cached. It's a huge, messy data cleaning and triaging problem that is some of the IP that we've built to capture all the data about the person, their claims history, their credit record, their auto driving record, et cetera, the house, everything about the house, aerial imagery, records-based imagery about the house, and then the location down to 80 meters in terms of, or even closer in some cases in terms of the exact attributes of that location and everything we can tie to it. Then we put all that data through our proprietary models. So we have our own pricing model, our own underwriting model, our own model that determines agent commissions, our own inspection model. All of these are driven from those hundreds of pieces of information put through our ML built algorithms, and that spits out those decisions. So the agent knows in literally 8 seconds, is this eligible? If so, what's the price? If so, is there going to be an inspection needed down the road, which is a small percentage of policies? And then if I do sell this, what would be my commission based on the lifetime value of the policy? And so that's the experience. And then if they want to sell it, there's a beautiful e-commerce style checkout for the agent where they use simple, intuitive sliders to customize coverage, to add additional parties or LLCs or whatnot to the policy, to pay with a credit card or by mortgage bill, however they need to, and to check out. And it immediately generates all the documents, PDFs them, sends them off to the customer and the agent, and it is a policy in the record. You can actually do it in like 2 minutes. I mean, I wouldn't recommend that. An agent should consult with the customer and make sure the coverage is appropriate, but it is very, very fast when you would like it to be.
Yeah, and that's certainly one of the hallmarks of modern insurtech is completely streamlining underwriting and claims. As a claims nerd, tell me how you're leveraging people, process, and technology to streamline the claims process.
Yeah, so the way we handle a small in-house team that assists with much of the in-house handling of the claims or the inside handling of the claims in a sort of a concierge fashion. And then we work with a third-party administrator who owns the file right now and who does the outside adjusting and whatnot. And we do leverage technologies to, we attempt to adjust claims without actually sending someone out to the house to the extent we can. Some of that is like pure straight through processing with, just a machine touching it. Most of it a human is touching in some way, but we try and keep that as an inside human. So someone is, either looking at, publicly available data of the house about the house, or we're sending a drone out to, take a closer look at the house and the damage that's been out there, or we use an app that allows the customer either at time of underwriting or at claim to go and take pictures around the house and give us a sense for the damage. And that is a part of the business that is very much evolving right now. The first value proposition of Openly out of the gates, you got to focus on something, was about making the quote and purchase experience as fast and accurate as possible. And I think now there's tons of room to continue on the claim side.
Awesome. Rob?
Yeah, Ty, just kind of, I guess, building off of James' question, your website mentions using cutting edge data and technology to provide customizable, competitive prices, customized products, tailored claims experiences. So maybe you can talk a little bit more like, you've touched a bit on the data piece, but, there are some other data elements that you want to talk about, and then any particular tech that you want to highlight that you guys are leveraging.
Yeah, I just say first of all, the one important thing to talk about is the fact that our tech stack is fully bespoke, but for, we didn't build our own payment processor, and we didn't build our own claim software. But aside from those two pieces, the entire, quoting, policy administration, generating of bills, even the financial accounting is bespoke. And the reason for that is that those pieces really need to tie together. The way our rating engine works, it actually divides every policy into like 65 little tiny components, from hurricane damage to the roof to fire damage to the other structures, things like that, and it accounts for all of those. It commissions all of those. It can even reinsure all of those independently. And so to build that hyper granular system, both for sort of all purposes, did take a fully bespoke stack that we built. And the way we think about it is, a lot of the IP that we have right now is in this upfront process of triaging all this data. We talked about all the messy data, but if you think about it, if you order every piece of data on every customer from every channel and every agent, that can get very expensive, because some of those are very unlikely. So we, native built into our system from day one is the thinking and the algorithms that say, hey, should I keep ordering data, for example, on this customer, or do I know enough? This house isn't going to fit our appetite, so I shouldn't pay the, whatever it is to order the next piece of data. I should sort of bail out of this quote. And it's very smart, and it's getting smarter at how it does that. And that ties back to this theme again. I was talking earlier about increasing transparency in insurance, and I just, I don't see a world where insurance doesn't continue to commoditize, and where transparent shopping doesn't become easier and easier and easier. And to win in that world, what you're going to need is highly predictive, sophisticated algorithms that measure risk, but also really smart algorithms that get to that decision cheaply, so that you're not wasting a ton of money on quotes that you never sell.
Yeah, that optimization, I think, is really key, and a lot that, particularly the large guys, they're just doing so much volume, right, that they don't necessarily think about the way that you would certainly at a startup. So it makes a ton of sense.
And it just gets to the point that there are so many areas of the value chain of what we do where we look at that and say, oh my gosh, let's pull on that thread, let's make that better. Everything from how the timing on which you bill people, the workflow of sending an application and verification of insurance to a consumer, the ordering of data pre-quote. I mean, there are so many opportunities. There are 40 things we can be doing. We can only do 3 of them at once, but we just see a lot of room to continue running, to continue improving and optimizing all the parts of our workflow, not just this upfront rating and underwriting piece.
Do your customers actually save money by using you? Are you actually driving the cost of insurance down?
Yes, we absolutely are. So we, like any insurance company, our rates are not going to be the right fit, and our product's not going to be the right fit for everybody. So, we're pretty selective at this point. We, agents already have some sense of which customers we're sort of after, what our market segment is. Nevertheless, we say no to about the 30% of the quotes that are submitted to us. So the system just kicks back a no. Of those, we are, of the ones that are accepted, or where we kick back a rate, we're probably competitive on 30 or 40% of those, and we have great faith in our pricing models that they're selecting the customers for whom we have a better opinion of risk in the market. And so we are absolutely saving people money, but that doesn't mean we can save just any customer money. It means we can save probably 40% of customers would save money with better insurance with us, and the other 60% we are content to have them remain with some other carrier. We'd love to win their business when it's the right fit and the right price and product fit, but for right now, it's sometimes not going to be.
Yeah, absolutely. Let's jump into another topic. And that was the one that we hinted at earlier. You only sell through independent agents. Now, this is completely counterstream. You're the salmon swimming up the stream here to pretty much everybody else entering InsureTech that's going direct to consumer, bypassing channels, selling online direct, and of course the big heavy now with their stock price rocketing up, Lemonade, who's selling homeowners and homeowners insurance direct to consumer. Where do you obviously took a counter position for a reason, Where do you stand on this and why?
Yeah, I come at it from two angles. One is that I believe consumers always win in the end, and it's taking a long time in insurance for consumers to pull that expense ratio down and get less opacity of coverage, but they will win. It will take may take another decade or two. And so you have to say, well, what is winning for a consumer in insurance? And from as much as I love insurance, from a consumer's perspective, this should be a relatively commoditized product that's pretty price competitive. And one thing that I, as a consumer, associate with that is being able to shop pretty easily for that. And so, when my relatives ask, how should I go buy insurance? I don't tell them, oh, you should go to 10 different websites of direct carriers and put in the same information over and over and over again and then print out the different sends and try and do the math in your head. I'd say no, go talk to an independent agent who will then go shop you with multiple carriers, and they can shop you for the best product, the best service. They can shop you for just the best price. It's you can kind of choose your own adventure, but it is clearly the right customer experience. And you say, well, yeah, but that's you got these humans involved, and over time machines will do more and more. That's absolutely true, but I think the limiting point for me of insurance is more like kayak than it is Delta Airlines website, right? So as insurance becomes more and more digital, I think it will be, my personal opinion is, it will be digital comparison platforms rather than digital direct go buy one product, and that's the only product you're going to buy on that website. So that's one perspective. It's the right way for the consumers to buy. The other quick perspective is that as a startup with one product and one price point to offer, paying the customer acquisition cost for insurance is really, really expensive. And you bring a customer to come and finally get them to agree to do a quote. And then, even the best converters of a single product direct are going to convert what, 10, 15% of customers. And they're going to sell, if you're a startup with one product, you're going to sell one product. And that is a horrible way to monetize a high customer acquisition cost. A much better way to monetize that is, or to deal with those economics, is to effectively split the customer acquisition cost. And that's what you're doing when you go through an agent. I'm splitting it with all the other carriers in that agency on kind of a, whoever wins the business pays it. But the agent, another way of saying that is, an agent is able to convert 40 or 50% of the homeowners quotes they do within the agency, which drives down the acquisition cost for everybody.
Yeah, absolutely. And that is a I think in the exuberance of technology, self-service, and ease of use, we do lose sight of the fact that insurance can be very confusing, and that you also have people that have, they buy multiple insurance products. I still use a personal lines broker for good reason. Yeah, I got got a bunch of different things to insure, and I don't have the time to peel through and read all read all my binders. Like, I'm
Yeah.
not gonna read through all those. Like, let somebody else do it. I'll pay a little bit more to let them read through it and then sort through all the options on the market. Like, plus, reputation, right? You want to, certainly you trust your broker to be in the industry enough to understand the reputation of the companies. You can have great marketing online, but maybe you don't pay through on claims well, and you do depend on that. So I think InsureTech for me is not solely about getting direct from the insurer to customer. It is about removing friction points wherever those are. And I think if you define it that way, or you're just removing friction. Look, reading all the binders and docs is friction for me to buy a policy. I mean, I am much more likely to buy a policy through an agent who's going to review it for me and watch out for my back, as long as I trust them. Right, as long as I trust them. And I did notice on your website when I went through, you do have the ability to connect people with an agent that's lives near them, and they can process their information. You pass the information on to them. Obviously, let the agent collect it and finish the quoting process. So you're addressing the consumer, but you're just directing them to someone who's riding nearby.
Yeah, that's right. But I would say 99.5% of our consumers do come in through the agency. I mean, we're trying to build out the Openly brand, but we're not going to be spending, 1.5 billion on marketing like we would need to drive lots of consumers to shop openly. That's just not the direction we're headed. And, I think you said it well, removing friction. But I think a good question to ask is, where is the most friction today? A consumer who maybe shops for home insurance once every 5 years, or an agent who quotes home insurance, 10 times a day. And the way we see it is by taking the time to quote and sell home insurance from whatever, 20 minutes a day, whatever, however you want to count it with the downtime, et cetera, down to like minutes or even seconds if they want it to be. We are saving agents time every day, all the time, day in, day out. Whereas for a consumer, that would be way more dispersed, and it just wouldn't be as concentrated a benefit to their life or their livelihood as it is for the agents.
Awesome. And Rob.
Yeah, I just would wrap up with echoing, you need to look no further than the deluge of ads that we see on TV from Geico, from Progressive, from State Farm, my former employer USA, and Ty's former employer Liberty Mutual. Although I do like the little guy that's the phone that jumps into the bag of rice. Personally, that's a little bit better than the Doug and Emu ads, in my personal opinion. But that costs a lot of money, right? And as an existing policyholder, that as an expense ratio we were talking about earlier, and gets me nothing. And so that actually kind of makes me frustrated as a policyholder with one of those firms. And even if you think about, well, I'm going to do digital marketing online and I'm going to do Google AdWords, and that's a cheaper way to go. It really isn't. If you think about some of the commonly used search terms that people are searching for insurance. And so, yeah, we've seen this, Pi Insurance, a lot of Hippo success has been tied to this, agency tie-in that they have. So InsureTechs have learned, I think, that the customer acquisition cost is not always cheaper going direct. I think that's a misperception out there. So I think your strategy makes a lot of sense, Ty.
And part of it is, what is your value? What are you really good at as a startup, right? Are you really good at marketing? Is that what you want to be? You want to be you are a marketing company. If you're spending to acquire direct consumers, that's almost all that matters. If you can market well for insurance, you should just do that, and then start to sell those leads or that agency to someone. That's not what we're good at, or what we're our spike, our key capabilities are in building this really fast and intuitive technology, these algorithms, these processes, better workflows that just make things easier, both the human part and the machine part that's downstream from the marketing. And so when we're really good at that, we say, let's take this product and give it to other people who are good at marketing. Agents are good at marketing. Let's let them market our amazing product. And they get it, by the way, right? I mean, because they use it so many times every day, they can easily be the evangelist to the consumer because they know what it means to have guaranteed replacement cost, even if a consumer might not. The agent will say, believe me, you should buy this. So anyway, it's worked out really well for us so far, and I love that it's working both in the short term for us, but I also truly believe that it's the long term for insurance. I think we're going to continue to go toward choice platforms in insurance. So those two both work for us.
Awesome. Well, great discussion today. And if you want more information, go to openly.com. You can go check it out, read about the company, and look at what they're up to there. I'm excited for you. I hope it goes well. And certainly from a technology development perspective, if you have any tech updates, I always want to hear them. I'm a commercial drone pilot as well, and so I love hearing about drone usage for underwriting and claims. I think it's incredibly useful. I don't think we need to send people up on roofs anymore to inspect roofs. That's just me. But all kinds of good things there. Let's jump into the news. Rob, I know you've got 3 news stories that are pretty relevant today.
Yeah, so a couple of these are related. The first is Corvus Insurance came out and they've raised $100 million, and they've really specialized in the cyberspace, but they're looking to broaden their reach into other lines of business. So congrats to the folks at Corvus. I know a few of them, and so real exciting to see this kind of validation from the market. And you definitely catches your eye when you're talking about, nine figures. And then Cowbell Cyber also reported that they are raising $20 million in the Series A to scale their AI-powered cyber insurance offering. So again, both companies really kind of that focus on cyber, use of AI, and both securing funding to expand and go beyond. So I think it's a big week for cyber startups. And then finally, I thought this was real interesting. So James, Ty, interested to get your thoughts. This was an exclusive in Inc. magazine, or I guess website, whatever they are now, how Google's new career certificates could disrupt the college degree. And so Google is planning to offer online education, kind of like these massively online open courses like Coursera and others. And some education institutions such as MIT and others are already offering these certificate type programs. But Google is saying that you could potentially get a certificate for as cheap as $240, and it may be recognized in lieu of a 4-year college degree for certain jobs, as that degree is very much a barrier for many people in the marketplace. And I think Google is kind of looking to disrupt academia with this new model.
Yeah.
A lot of people have said that it's ripe for disruption, but we haven't really seen it yet at scale. So curious to see if you guys think Google will be successful.
You know why you haven't seen it? Accreditation bodies. There is a snowball's chance that you're going to see a free or really inexpensive program get accredited by the major accrediting bodies that and that's because I mean you have to you're looking at, and full disclosure, I'm a regent at a public university, so I should mention that. And first off, as someone who's taught in the university classroom for years and as an administrator at a public university, I can say there are very few replacements for actual face-to-face classroom time. That's why COVID's been so damaging, is because you eliminate the relationship building that occurs in college, a lot of the maturing that occurs when you're going and living on your own and plugging into student life. It's like the other education, we call it at Texas A&M, where you're plugging into student activities. The Corps Cadets was the other half of my degree at A&M, which is a military college inside A&M. That was the other half of my degree. And that wouldn't have happened online. You can't do a core online. And so, first off, I love that we're going to make education widely available, because every study I've ever seen says that education drives earning potential up. Any education, literacy drives, and that drives global domestic GDP up. That drives of course, let's talk about economics again. It improves economies, it improves companies, it improves quality of life for everybody, right? That life and the planet are not a zero-sum game. Wealth is created from nothing. And so education is a major upgrade for human beings. And so I am for anything that will upgrade human beings and their education. And this is great news. And I know I've taken advantage of online courses. Universities, many professors at universities have been posting their content during COVID on YouTube and just telling their students to go watch YouTube and fill out an online quiz. And I got to tell you, they are precipitating some of their own challenges by doing this, by not engaging in online interactive classrooms and just say, go watch a video and take a test. Well, shoot, what's the difference between that and just going to YouTube to learn, right? I mean, my daughter is now almost 11. She turns 11 pretty soon here. She learns everything on YouTube. And I mean, the skills she comes down with on a daily basis, craft, she's really into crafting, and she learned how to pack bags from YouTube. She learned how to plan her travel from YouTube. She learned how to do all of her makeup. She's doing makeup in kindergarten, learned it on YouTube. I mean, she's just a YouTube junkie. And so there are cultural things that are happening right now that are going to be really seismic. But the universities have accrediting bodies that are going to ensure that the only people who are accredited follow really stringent standards. And so I think that's going to be when you talk about disruption, that's going to be the hurdle they're going to have to get over, is actually getting programs like this accredited with the major accrediting, like accrediting bodies, right? That's the big hurdle. If that makes sense?
Yeah, Ty, curious, what do you think?
Well, I don't remember exactly how much Duke charged me, but I think it was more than, what'd you say, $240?
$240. They probably
Yeah,
got a little
so
more out of you.
$240 a minute at Duke.
I can't help but think that I'm owed some sort of no. I think there's maybe an interesting parallel in the corporate world where, we are a remote first company. We've almost had to be. We would likely have gone that path anyway, but we've almost had to be due to COVID. We during COVID, we've grown from 15 people to 65 people. We'll probably be 125 people by the time that the world is more open. And in the short term, it has worked very, very well for us. I think we're extremely efficient, and there's huge benefits to it. I do wonder about the longer term, maybe the analog being the other things that college gives you beyond just the book learning. So I do wonder what that's going to do longer term to our culture. And so we're having to figure out what's the middle ground there. Is it that we every X weeks we all meet up in some city in some way, or is that trying to pave the cow path? So ongoing research project or science project, I feel like, at us, but at our company, but I'm sure a lot of other companies too. But it's interesting. I of course agree and support more widely available higher education. I've certainly benefited from it, and been very fortunate in that way, and support whatever gets that out to more people.
Yeah, fantastic. And yeah, I've thought the same thing, Ty, and James, I'm sure you've wrestled with this of, it's great that people can continue operations, particularly those that were based in an office and then had to kind of make that move to fully remote. But we know the water cooler time in many cases is overrated, right? That was just kind of a time suck. And you were talking about, right, what are Harry and Meghan talking about to Oprah or whatnot. But there are some innovation, there's some brainstorming, there's some collaboration that doesn't necessarily happen, each and every day when you're just meeting after meeting after meeting, just getting down to business. Where are we on this project? What's the status? What needs to be next, et cetera. And so I do think sometimes there is something lacking. And to your point, like, how do you facilitate both? I think is definitely a challenge that a lot of folks have been wrestling with, from startups all the way to Fortune 500.
Yeah.
Absolutely. And look, COVID's it's like water, right? It permanently changed things. And we'll see how permanent a lot of the changes are in the very near future. What it did do is it forced everybody to accept that remote works for a whole bunch of our lives. And I tell you what, rents are severely depressed in New York City right now because of it. I was reading an article this morning in the Wall Street Journal that landlords are choosing not to rent rather than rent at the lower rates in hope that it will recover soon. And I'm like, it ain't going to recover soon. People have moved. They literally moved. You got people like Ty who went south to Charleston, and they're staying there. You ain't going to leave paradise.
All our neighbors are from New York or Boston or Chicago, to be honest.
Yeah, they're like, no, we're out. They want space and neighborhoods, and it's interesting. Education is at an interesting inflection point. It's something that we certainly talk a lot about at Texas Southern, and student success, of course, is number one. And I tell you what, we have a lot more student success. I'll tell you this: when they live on campus, they attend classes, we see them face to face, and we can provide face to face mentorship. A lot more of them graduate. They have a better student experience, and they're more successful. And we look at a lot of data, a lot of numbers, and so that's certainly what we got to factor in. Well, thanks for bringing that up, and as always, Rob, just thanks for being my compadre on this whole deal. Ty, appreciate you being on. Thank you for your work in the insurance business, and thanks for joining us on the InsureTech Geek podcast.
No, thank you. I really appreciate the opportunity. It was a pleasure speaking with you today.
Awesome. And Rob, I guess I'll see you next week, huh?
Yeah, looking forward to it.
Spring break here in Texas. So if you're, at least it is in College Station. Is it spring break in San Antonio?
It is this week. So yeah, you guys are a week after us, and it's actually like spring, unlike 3 weeks ago.
Right? Yeah, it's in the 70s, man. It's fantastic. So I'll be in Ty's neck of the wood next week, hanging out over in Charleston. So going to enjoy that. But again, to all of our listeners, thank you for joining us this week. Super appreciate you being on board. And again, this has been the InsureTech Geek Podcast, powered by JB Knowledge, jbknowledge.com. It's all about tech that's transforming and disrupting the business world. I've been your host, James Benham. That's jamesbenham.com, with co-host Rob Galbraith, endofinsurance.com. Big thanks to Jim Greenlee, our podcast producer, Kara Daltonara, our creative producer, and thank you for joining us today. We're taking you on a journey through insurance tech, so enjoy the ride and geek out. See you next time.